Well, thanks for tuning into this earnings conversation with me, Neeraj Shah, and we're talking to the top management of Mphasis, Nitin, Rakesh, CEO, and Manish Dugar, CFO of the company, join us right now to talk about the quarter gone by and the outlook ahead. Well, maybe the half gone by and the outlook ahead. Gentlemen, both of you, good having you. Thanks for joining in. Nitin, let's start off with you, and Manish, of course, great talking to you for the first time. Look forward to many more interactions. But
Same
Nitin,
here, Nitin.
Nitin, start off with you. How do you see the quarter gone by? I mean, as I look, that there are a bunch of tailwinds that are getting formed for the space at large, and you are no different. But how do you kind of map what's happened in the quarter?
Again, thanks for having us, Neeraj. I think very pleased with the quarter performance. Clearly, you referenced some tailwinds. I think they were just about a quarter ago. There were signs of headwinds with the COVID crisis. I think the investments we made in competency, and the ability to help clients transform their estate, especially when it comes to digital transformation, has actually really been very powerful as we've gone through the last few months. So I think very pleased with two or three things. Firstly, I think revenue performance has been very strong on a sequential basis. We grew by 6%, the highest growth sequentially company has seen in over a decade. Secondly, I think the highlight of the quarter was the tremendous deal wins we saw at 360 million net new TCV, for Q2. This is the second quarter in a row of record deal wins, and we've clearly, on a YOY basis, is 75% higher than the first half of last year. So I think clearly very strong performance on that front. Very enthused by the positioning and the faith that the clients are giving us. The market is tough out there purely because it's very competitive, but I think we're very pleased with what we've achieved.
Yeah, and you reckon that the outlook is looking optimistic despite the DXY declining, right? Because I think that you delivered a strong performance despite the DXY drag.
Yeah, I think there's obviously a little bit of an internal shift of business. If you look at our direct business, it actually grew almost 11%, 10.9% sequentially. Probably at least so far, industry leading performance from the direct business, and of course. That the overall growth got a little bit muted, and we ended up with 6% net growth. But I think you're absolutely right. The pipeline has never been stronger. Despite the record conversions 2 quarters in a row, our pipeline is still at a record high. Two things are driving the pipeline. Firstly, we are seeing a number of transformation-led deals that continue to pop up. The teams have worked really hard in originating those deals, despite the lockdown situation, from a sales standpoint. Secondly, I think the ability to apply multiple levers, bring all of our tribes together, from application transformation, DevOps, cybersecurity, cloud capability, infrastructure transformation. I think the ability to structure large deals has also gone up dramatically for us in the last, I would say, year or so. So I think combination of large deals driven by competency capability, and the fact that we are seeing multiple transformation-led deals is giving us the faith and confidence that we can continue to see good performance in the quarters to come as well.
Manish, could part of this also be that you got the margin tailwinds and that have enabled you to make large investments in sales? How do you look at that picture? How do you look at the cost versus the investment picture?
Absolutely. Staying true to our philosophy of sustained margins and investing for growth, I guess this was clearly a quarter of execution. Like Nitin mentioned, we have had 3 quarters of excellent TCV wins. And not just in terms of absolute total amount of TCV, but in terms of size of TCVs as well. And we invested in ensuring that we did execute them, and that's what translated to the 6% plus sequential growth in revenue. And while we had to make investments in ramping up the team, which is kind of reflected in how the utilization looks like, but those were all conscious choices we made, because of which we were able to deliver the growth that we did. So absolutely, tailwinds in profits did not come in the reported EBIT numbers, but it certainly reflected in the investments and hence the revenue delivery.
And will that start reflecting in the EBIT numbers at some point of time? Because the other point that I wanted to ask Manish is that almost everybody unanimously agrees that this whole change of working methodology, the option to work from home, the reduced travel. I think Chandra was on one of the global dailies saying that he had to travel so many miles to do deals worth $50,000, and now people are clocking in $2 billion worth of deals on Zoom calls or what have you. So how does it work for Mphasis? How are you seeing that picture?
Absolutely. I guess it has given us a lot more time, and we are productively utilizing their time in not just being closer to the customer and winning deals, but also in doing better execution. And while it has given some benefits in terms of reduced costs, but the endeavor has been, like I mentioned, to invest for growth. So, opportunity for being closer to the client and, be partner to them when they need us most will decide who they work with in the future. And that's what we have been trying to do.
No, agreed. But I'm just sorry, just one follow up. I'm just trying to wonder that if do you have this option of, or you have this small tailwind for however long it lasts,
Yeah.
for traveling less, for having lower costs because employees are largely work from home as compared to work from office or whatever, what have you. Is
Yeah.
that something that will show up as a tailwind? Because I mean, it's not just you, right? The industry is doing it, so there's no way of bifurcating that. Hey, Mphasis is cutting costs here, but others are not. Everybody's doing that.
So Neeraj, maybe I can take a stab at that. I think the philosophy is very simple. I think we have enough flexibility and nimbleness in our operating model to adjust and make those decisions on a pretty dynamic basis. I think at least for the last couple of quarters, obviously Q1 was all about stabilization and making sure that we get through the first 3 months of the crisis. In Q2, the decision was very simple. If we given the option, and we had those options available, the scenario that we worked on was, can we maximize the growth and the wallet share gains, even if it means that we have to actually not put all of the savings back into the P&L. And that's exactly what we have done. I think we make those decisions and those calls based on the business environment, the client demand, and I think there's tremendous opportunity for us to obviously take that operating leverage and put it back in the profits, or continue to make investments. I think we've ramped up our investment significantly, especially in capability build up, and we'll continue to do that dynamically. So I think at this point in time, short to medium term, yes, those tailwinds exist. We are being really strategic about using those tailwinds to gain much more wallet share, and that's why you're seeing elevated levels of revenue growth.
Yeah.
Okay. So I'm guessing that revenue growth would remain at the forefront of all exercises right now. Nitin, you've mentioned about the strategy of the front to back transformation, something I believe 12 to 15 or 18 months ago, if I'm not wrong. I don't have the exact timelines with me right now. Excuse me for that. How is that starting to show up? Because I think when I read brokerage notes, almost everybody says that that is something that is starting to work and show results now quite meaningfully.
I think you're absolutely right, Neeraj. I remember 2 years ago when I did an interview with you from your studios, we talked about front to back, before, during, and after the interview. I think our approach, the reference I made to the investments we were making for the last couple of years in helping clients adopt digital transformation really got accelerated. And I think, I'm a big believer of, one of the old sayings from Lenin, which said, sometimes for decades nothing happens, and then sometimes decades happen in weeks. So I think that's exactly what we've lived through in the last 6 months, where the acceleration of all things digital was tremendous. And our ability to bring all of our capabilities that we've been building out for the last couple of years was really the primary reason for us to be able to stitch together these large deals that you're seeing in our TCV wins.
Okay. Finally, a couple of things, and either of you can take this up. Maybe Manish can take this up. Maybe Nitin can take this up. I'm just trying to understand what is the nature of the new deal wins happening, aside of what's happening with Blackstone, etc. I mean, various companies or various your peers are doing different strategies. I wonder what you're doing. Are you trying to, for example, in a lot of new wins, trying to get the foot in the door, even if it means that let's maybe do it at slightly competitive pricing, and then eventually over a period of 3, 4, 5 years, if indeed deal tenors are so long, try and expand the margins, get more from the same client mining, etc. Because I see that you're doing that with your existing clients. What about the newer ones? Because I'm guessing the opportunities are presenting themselves large.
Absolutely great question, Neeraj, and I'll take a stab at it. And if Manish wants to add something, he can definitely do that. I think there are multiple deal archetypes depending on the situation that you're in. Right? If you think about the primary objective that clients set out early on in the crisis was crisis management, getting up and running digitally. Then they very quickly shifted their focus into, okay, I need to figure out how long, we don't know how long this crisis will last. We need to find ways to conserve cash, cut discretionary spend. And then over Q2, we saw them move dramatically into accelerating transformation. So depending on the environment, the nature of the relationship, what we've definitely done very, very well is consolidated our position in our top accounts. Almost each of our major top accounts has gone through a similar cycle, whether it's vendor consolidation, whether it's discretionary spend reduction, whether it is ruthless prioritization, as they call it. And I think we've come out on the right side in most cases. Then of course there are some other deal archetypes where you bundle what we call zero cost transformation, where you bundle transformation with cost run reduction and you self fund it. Those require a slightly longer term viewpoint. I don't think we go into any deal trying to price our way into the win, and that normally doesn't work. I think in the current environment, what really works is your ability to understand what client is looking for. Sometimes they're also not very clear in articulating that because things have happened in such an accelerated manner. And if you really get close to the source of the definition of the problem, you're able to then stitch together a transformation roadmap that the client very quickly is buying right now. So I think that's kind of the model that we are following. I am not a big believer in pricing yourself out of the market, either on the upside or on the downside. So as long as you have a fair price, clients give you a lot of flexibility, as long as you have the right capability and the competency.
Manish, you want to take a stab at it in Nitin's word?
I would just say that given the majority of the deals that we pitch are proactive, and it's kind of we are trying to tell the client a problem that they didn't even know, and it's the value that we are delivering. The conversations are not necessarily on the price, and given we are able to work with them on strategic projects which not just have cost impact but more revenue impact, they are willing to work with us on a longer term, which gives us an opportunity to kind of structure the arrangement in a manner where they get the savings from day one, and we are able to do the transformation, give them a transformed landscape while making profits for ourselves. So most of the deal wins that we have had are actually not because we priced low. We were actually not the cheapest among the vendors. And this also goes on to show that eventually when the transformation is done, the client is not just looking at us for that project, but more and more, and we eventually start getting larger share. So contrary to the belief that typically consolidation of vendors benefits larger players who have economies of scale, we have actually seen it playing for ourselves because of competency and capability.
Okay, so Manish, final question to you, and then final word from Nitin. You've already given the guidance for operational metrics. I wonder if utilization, etc., kind of stay at the current levels, or maybe help you get some more tailwind. I'm just trying to get a sense of how do you envisage the picture for the next couple of quarters. I presume it's futile to talk about the next 18 months because technologies are shifting so fast.
From a EBIT margin perspective, we have stated in the last 2 quarters, and we continue to follow that guidance of 15.5% to 16.5% EBIT. Utilization and various other operating metric will be driven and guided by what we need to do to deliver to the client and continue to focus on investing for growth. So, we are not necessarily looking at optimizing for an operating lever, but more in terms of optimizing for client satisfaction.
Okay, Nitin, final word. You just trying to get a sense of how to. I mean, in your case, from your perspective, do the next 6 months throw up something beyond what you could have thought of, simply because of the shift in the nature of the demand for the industry, as well as in your case, aside of the normal demand that comes in, the Blackstone portfolio that probably adds to the tailwinds, and anything else that you believe people should be watching out for when they're looking at Mphasis?
So I think, Neeraj, 2 things I want to talk about. Firstly, the IT services buying client base is very mature and very sophisticated, right? So you cannot have a one-hit wonder type of an event where you get lucky and you win a deal and then you can't replicate it. I think we have to create a sustainable growth environment and a sustainable competency-led differentiation that continues to give you wins quarter after quarter. And I think that's the way we've built the business over the last 3-4 years, and that's what's reflecting as things got accelerated. Secondly, I think you talked about engines, drivers of growth. I think we've always believed in broad-based growth, strategic accounts, new clients, Europe, Blackstone portfolio. They all go into that mix. I think there's a myth that Blackstone portfolio is an added tailwind to us because each and every one of those Blackstone companies also actually goes through a fairly sophisticated buying process, because that's just the nature of the business, right? There's no low-hanging fruit. There's no easy wins to be had in any segment of our business. So I think the way we are thinking about it really is continue to execute on the pipeline, which, as I said, is at a record high. Continue to executing on towards converting that pipeline into revenue, which in the current environment is non-trivial because we are doing remote transitions, remote workshops, remote knowledge transfers, remote architectural sessions. Everything's kind of working in this atypical remote manner. And I think finally, I think the sustainability of the business over the long term, I think this is a very interesting year for the industry. You'll have players that will grow. That the divergence in growth will be in double digits, just the divergence in growth. I mean, this is not a year that I remember, a similar year, even in 2008-9 crisis, because everything kind of went down together and everything came back together. Yes, there was difference in growth by 3-4% points. This is a year where you'll have negative growth and you'll have positive growth, and they'll both be on extreme ends. So I think our effort is to be on the winning side, which so far the year is playing out really well for us. We just have to keep executing to that and make sure that we keep making adjustments on strategy and execution as things change and evolve.
Top percentile on the winning side, Nitin?
Definitely, that's the attempt. So far, at least, it looks like, based on the current quarter performance, that we're definitely in the top quartile, top decile, whatever you call it.
Okay, well, gentlemen, both of you, wish you all the best for the quarters ahead in execution. More importantly, stay safe. And thanks so much for speaking to us at Bloomberg.
Thanks for having me, Neeraj. Thanks for having us.
Thanks, Neeraj.
Bye.